Alright, for the last couple weeks I've been wanting to get a video up showing a bunch of charts because there's a lot of red flags going up for over the intermediate term in stocks and some for even a longer term. So for anybody with a substantial amount of money at play, wondering what to do with it, I think looking at some of this stuff can maybe help you make a better decision and could make a big difference over the next year or so. So I'm just going to go through a lot of charts and hopefully not spend too much time on each one, but kind of show what's going on in some different areas, and hopefully that'll help clear up the picture here. I think the market's at a very extreme risk of a sharp decline, whether that's 10-15% or actually a lot larger than that. And time will tell on that, but let's get to some of these charts. This first one, and let me just say that almost all these charts initially are from sentimenttrader.com. It's a great site, subscription site, about $25 a month. So if this kind of stuff interests you, consider subscribing to that site. And I believe they have a 2-week free trial period, so you can look at everything without even having to pay anything initially. Anyway, this is kind of a comprehensive thing they call smart and dumb money confidence. This is the smart money up here. Whenever they're very confident that the market will rise, it typically does shortly thereafter. Whenever the dumb money is very confident the market will rise, it typically falls shortly thereafter. And down here it looks at the difference between how much difference is there between the smart and dumb money confidence. And what's happening is that dumb money is very, very confident that the market's going to continue to rise, more so than any time in about the last 3 years, since near the end of the last bull market. Early 2007 time frame, and the spread between the two is as high as it's been since that time frame as well. So that might only be an intermediate term signal. This might be a bull market that just corrects a bit and goes on up, but that also is something it's higher than it has been in the last 3 years, so that's could be pretty significant for a longer term decline. This chart shows the ratio of volume in the NASDAQ to the New York Stock Exchange, and what happens typically is when markets are reaching high points, the NASDAQ volume will increase relative to the New York Stock Exchange. That's typically attributed to the fact that the NASDAQ stocks have a higher volatility, they're more growth oriented, so when people become confident that stocks are going to appreciate in price and capital gains, they'll tend to flood into trading these high growth, high beta stocks and not give so much attention to the safer stocks that would probably offer higher dividend yields and that type of thing. So that hit a pretty extreme level this past week, up at this 2.6 level. Every time that's happened over the last year, it's at least led to kind of a short-term decline. But when you look at this over a long-term time frame, this shouldn't be viewed as a healthy thing for stocks. This chart shows the stock to bond ratio. Again, when people feel, the investing community feels very confident that stocks are going to rise, which usually happens after they've gone up a lot, they start to move money into stocks, move money out of bonds. Those are the two primary investment asset classes that money gets rotated between. So if you look at simply how stocks are valued relative to bonds, you can get a feel for whether that is too high or too low. And this red line shows its 2 standard deviations from the last yearly mean, and this is over 2 standard deviations here as of the last week or so, which is 95% of all data should be inside there. So when you see it get outside of those levels, these 2 standard deviations, you know what's happening is significant. Again, it doesn't mean that this will lead to a huge decline, but it does show you that stocks will typically give back quite a bit of gains in the months after this type of thing happens. This chart is robo put call ratio, which is the retail only, buy only. So it's basically showing pure call buying and put buying, and this is a couple of standard deviations beyond the mean for the last year. Whenever this ratio gets very low, this is an inverse scale here, so the higher this line goes, the lower the ratio is. That will typically correspond to market tops. And this has actually been very low for the last month or two, and it's kind of gone somewhat parabolic. So I think this could end badly for stocks here, because the dumbest traders typically are the very small traders, which this indicator is looking at, and they're kind of getting very, very bullish, and it's kind of showing a parabolic turn up in the call buying and down in the put buying. This is a index, they call the option speculation index, showing total bullish bets divided by total bearish bets as far as opening transactions. And this is just, again, going parabolic. It's been very, very high amount of calls relative to puts, and it's been that way for a couple months. But it's continued to move up parabolically, and that is actually the highest it's been over the last decade. Even in 2000 at the tech bubble peak, it was a little bit lower than it is right now. So again, this doesn't have to mean that the market's going to crater from here, but you're seeing some signs that are potentially have long-term significant signs that there might be some type of a speculative frenzy in highly leveraged derivatives, in this case in the options. This is total put call ratio, so this looks at both the ratio of options traded on individual stocks as well as on stock indexes. The indexes tend to be hedging type of instruments, and sometimes will be reflective of smart money, so there's both a smart and a dumb component here. But the takeaway is whenever you see the ratio fall, that means there is less demand for puts, and that typically means that the market doesn't see risk, and of course from a contrarian point of view, that's when the market is at the most risk. And for the first time in the last, since May, the 21-day or monthly average here is a couple of standard deviations away from the mean. So looking back through the chart, that tends to happen at tops in the market. This is a similar chart, but it's looking at the equity or individual equities only, and this tends to be more of a true dumb money measure. Seeing some of the same thing here, seeing these ratios kind of spike down, and that will tend not to be good for stocks over the intermediate term, over the course of several weeks to several months. This is looking at the spread between the OEX put call ratio and the equity put call ratio. I've talked about these a lot on the blog before, but the OEX is the S&P 100, so it's an index, and it is typically a good smart money indicator. So when a lot of puts are traded on this, that is typically signs of hedging, because smart money sees downside risk in stocks. And so looking at how, if the spread is very wide, it's showing you that the opinions between the smart traders and the dumb traders is very wide, and we're seeing that that spread reach its highest level in the last couple years, over the last few weeks, which is another negative sign for stocks. This is another less popular index as far as looking at calls and puts, but it's the ISE, International Securities and Exchange Sentiment Index, and this is a 10-day ratio of the call to put. So in this case, the more bullish they are, the higher it'll be, the more calls that are traded, and that's getting pretty high, which have corresponded to some of short to intermediate term pullbacks over the last few years. Now, this is a chart of cumulative tick, which is a commonly tracked indicator. And just to give a little background on this, the tick is a measure of how many stocks traded on an uptick versus a downtick, with the idea that the more stocks that are trading on upticks, the more buying interest there is in the market. Now, one of the reasons this is so important is that these days most of the trading that occurs in the markets is not people like you or me that are sitting down on our computer and trading. It's done by these